Should you invest in gold this year? The yellow metal has gained nearly $470 or 22% so far this year, mostly due to geopolitical tensions, prospective US Federal Reserve rate cuts, and uncertainty created by the upcoming US presidential elections. Not to forget, gold's glittering rally is due to markets anticipating deeper Fed cuts. As shown here in this graph, the price of gold in 2024 hit record highs above $2,500 per ounce, and it is now on track for its biggest annual gain since 2020. Meanwhile, here are a few pointers to keep in mind. Gold remains one of the best performing assets of 2024. The purchase of gold by central banks worldwide grew 6% year-on-year at 184 tons. This was caused by the need of portfolio protection and diversification. Central banks further reported 12 tons of net buying in June via the IMF and other public data sources. Investment demand for gold in the second quarter of 2024, and here we are talking about bars, coins, and gold ETFs, was marginally firmer year-on-year at 254 tons. Global gold ETF holdings in Q2 saw a decline of 7 tons. This is compared positively with 21 tons drop in the same period last year. Gold and technology jumped 11% year-on-year as artificial intelligence trend continued to push demand. Ole Hansen, head of commodity strategy at Saxo Bank, spoke to us about the current performance of gold and its outlook for the remainder of 2024.
Gold clearly has had a very good, strong performance this year, and it does come on top of an already strong year last year. We are currently up around 16% or close to 16% priced in dollars. That's on top of the 13% that we achieved last year. Over the last 10 years, gold has been averaging an annual return around 6%. So clearly, the last couple of years we have been exceeding the longer-term performance expectations for gold.
According to a recent World Gold Council report, gold has been trading above $2,300 per ounce for most of Q2. And during June, global gold ETFs attracted $1.4 billion in inflows, with all regions recording positive gains except for North America. Now, the main reasons why gold has performed well in the first half of 2024 is continued central bank buying, Asian investment flows, geopolitical uncertainty. Central banks buying gold has been a major reason why gold prices have gone up in recent years. The World Gold Council estimates that the central bank demand for the yellow metal contributed at least 10% to gold's performance in 2023 and potentially around 5% so far this year. It is also anticipated that central banks will continue to buy more gold than usual this year, which is also the view held by Metals Focus in their latest Gold Focus report. And according to a report by Goldman Sachs, gold prices are expected to rise as central banks purchase the yellow metal and as strong retail demand in emerging markets bolsters prices. Andrew Naylor, head of Middle East and public policy at the World Gold Council, shares his insights on what led to gold performing well so far this year.
It's been a very strong first half of the year for gold. There are a couple of things that I would point to that have driven interest in gold. So one has been central bank buying. A couple of years ago, we had record levels of central bank buying, and actually central banks buying gold has been a trend we've seen since 2010. They've been net buyers pretty much since 2010. But a couple of years ago, we saw record high central bank interest in gold, and that's continued, not quite at the same levels, but we've seen very strong interest from the official sector so far this year. Over $145 billion of gold is traded every single day, and it's for all of those reasons that we see institutional, individual, and official sector interest in gold. So the official sector has been one driver. Another major driver has been retail demand, particularly in Asia and more specifically in China. We've seen very strong interest from retail consumers in China, and that's been a significant source of demand for gold in the first half. We saw bar and coin demand increase slightly in the first half. Jewelry was fairly flat, but when you dive into the details, it's really about retail consumption in Asia.
Asian investors have played a significant role in boosting gold's recent performance. This is clear due to the following reasons: demand for gold bars and coins, investments in gold ETFs, and activity in the over-the-counter market. Among the major markets, Asia registered inflows of $3.1 billion in the first half of the year, outpacing all other markets and the only region recording positive flows.
Another major driver has been retail demand, particularly in Asia and more specifically in China. We've seen very strong interest from retail consumers in China, and that's been a significant source of demand for gold in the first half. We saw bar and coin demand increase slightly in the first half. Jewelry was fairly flat, but when you dive into the details, it's really about retail consumption in Asia. So a combination of those factors has underpinned gold performance, and then layered on top of that, we've seen some momentum and tactical buying as well. As the price has increased, you do see algorithmic trading starting to kick in. Other more sophisticated and institutional investors as well tend to try and ride that wave of momentum.
So clearly, the last couple of years we have been exceeding the longer term performance expectations for gold, and the reasons for that are multiple, and those multiple reasons are potentially also the reason why we could see prices continue higher in the medium to long term. We're currently dealing with a world that which is not breaking down, but where we have heightened geopolitical tensions, we have trade wars, we have actual wars going on. We've seen that basically lead to increased demand for gold in the past few years, especially since Russia invaded Ukraine in 2022. Central banks since then have been very strong buyers of gold. They want to diversify their holdings to a certain extent away from dollars. At the same time, we have a slowing economy in China, where the property sector is no longer guaranteeing the returns that people are looking for as safeguarding their pensions, and that means as well that gold has been in very hot demand from retail, from middle class retail investors in China. And then we have the whole global debt situation where we are seeing countries increasingly increasing their debt burden. That is raising some concerns among investors who want to safeguard their money. We're seeing family office and high net worth individuals in the last 6 months, according to the World Gold Council. They have been very strong buyers of gold, and that's basically part of that is to safeguard any worries about a potential debt crisis stemming from the continued issuance of debt to finance activities around the world.
Now let us move on to the outlook of the yellow metal for the second half of 2024. The World Gold Council said that gold may continue to move in a similar range to what we have seen in recent months. According to a JP Morgan report, gold prices will peak at $2,300 per ounce in 2025. The predictions about gold prices are based on what the Federal Reserve thinks will happen with inflation. They expect the core inflation to slow down to 2.4% in 2024 and 2.2% in 2025, and then go back to their target of 2% in 2026. Goldman Sachs, on the other hand, says the yellow metal is forecast to climb about 6% in the next 12 months to $2,175 an ounce.
We launched an annual survey of reserve asset managers just a few weeks ago, and the outlook remains strong when you look at gold as a reserve asset. So central banks, they on average account for about 19% of demand every single year. But when we asked reserve asset managers, do they think that the share of gold reserves will increase, or will gold be playing a more important role in reserve portfolios? And the answer was overwhelmingly positive. So the outlook for central banks, we think, remains strong.
Here are 3 factors that may affect gold's performance in the second half of 2024: interest rates, recession risks, and geopolitics.
We were back in December. We were looking for 2,300 as potential target. That has now been raised to 2,500, a level which I think could still be achieved. But that missing cylinder that this engine needs really is the rate cutting cycle to begin in the U.S. we have historically seen that when rate cuts start to occur in the US, then the gold tends to do well in the months and quarters that follows.
Now the question here is, what could be the risks of investing in gold? And could there be other better options to invest in within the commodities?
Similar to pretty much every other asset classes, you have those market risks. With gold, though, it's very important to understand the legal structure of ownership. And by that I mean whether that gold is allocated to you or not. So for example, when you're buying gold bar or coin or jewelry, if you're taking it home and you bought it outright, it's yours. You've got no counterparty risk. But there are products out there where you don't necessarily have an investment in allocated gold, where you have legal title to a specific bar or coin, but you have a general entitlement to a pool of gold. That has a very sort of different risk and legal profile. So it's very, very important to understand how the gold is held and your legal title to the underlying asset, particularly if a third-party institution is holding it on your behalf.
To recap, gold might stay within a certain price range if current market predictions turn out to be accurate. Gold prices could retreat in the second half of 2024 if interest rates stay high for a longer time and central banks reduce their gold purchases significantly. I'm Farah Heiba. Thank you for watching.